Hey guys, Mitch Nelson here, real estate investor. Just doing a little bit of driving around today, going to check on some of my fix and flips. I had a thought I wanted to share with you, particularly about fix and flips. A lot of the people that I coach, the people that I teach how to do what I do, a lot of times they come to me with ideas that are very employee mindset based. And if you know anything about me, if you've read my most recent book, Mindset to Millionaire, you know that I teach people to be more wealthy mindset individuals rather than employee mindset. And even investors, people who I've taught for quite some time, still occasionally have a hard time breaking out of that employee mindset. So I want to talk about the three different types of investors, particularly when it comes to fix and flips. So type number one is the type of individual that wants to move into a fix and flip. Now that may be for a number of reasons. Maybe they can't come up with any more creative way to buy a property than just to get a mortgage on it. A mortgage company looks a lot more favorably on an individual when they're owner occupying a house rather than when they are purchasing a house as an investment. So it's easier to get a mortgage when you live in the house. The other reason an investor might choose to move into a house while fixing it up is that they think that they can save money by doing the work themselves. Now, from one perspective, I see why they think that. But if you really look at the situation as a wealthy mindset real estate investor would, you're actually not saving any money. I currently have 5 fix and flips that I'm doing at one time. Now, this first type of investor that we're talking about wouldn't be able to do that. If my plan was to move in and fix it up myself, I could only do one at a time. And my average repair, I do a really high-end repair on the properties that I fix and flip. My average repair bill is about $50,000. So let's say that I could save $10,000 by moving in and doing the work myself. Well, like I said, if I moved into it, I could only do one at a time. So from that perspective, if I were to move into a property and fix it up myself to save $10,000, I'd be stepping over $100,000 in potential profit in less time. The second type of real estate investor is the type of investor who likes to structure all of their money as debt. They understand the principle of leverage. They understand that you can make more money when you leverage other people's time and leverage other people's money. But this second type of investor doesn't understand fully how to structure money. And so he may borrow as debt the entire cost of fixing up the property, as well as the entire cost of purchasing the property. Now this creates a problem because a lot of times fix and flips will have between $10 to $20, $30, $50,000. Sometimes I've seen $70,000, and if you're lucky you get up over $100,000 in profit. What if 2008 were to happen tomorrow? We can't control the market. Your guess is as good as mine as to when the next collapse is going to happen. There's indicators in the market that we watch, but nobody knows the exact day or the exact hour that that's going to turn. So I treat every property as if we're going to have a downturn in the market tomorrow. So this second type of investor that structures everything as debt, if they've only got, let's call it $30,000 in potential profit, that's all the room they have to lose before they're break even or they're negative, right? Well, most of the properties that I do are, they cost me over $250,000 to purchase, and I sell them for over $350,000. And between that and the other fees and the repair costs and whatnot, usually I profit on average somewhere around $30,000. Well, if 2008 were to happen tomorrow, everything over $250,000 got a $100,000 haircut or more. Now, most downturns aren't that severe, but there's nothing preventing that from happening again. And as educated investors, we like to protect ourselves against that kind of thing. The type 2 investor that we've been talking about only has one exit strategy, and that is sell it for more than what he put into it. Well, that's risky. And now, I can see, looking at that perspective, I can understand why people say real estate is risky, because that is a very risky approach. one exit strategy, one plan is not enough. The third type of investor I want to talk about is the type of investor that I am and that I teach my students to be. We'll call it an educated investor. The educated investor understands that they have no control over the market, that it can turn at any time, and if they're caught holding a property when that turn happens, then they could potentially lose money for themselves and for their investors. And an educated investor wouldn't let one simple property make or break them. The sad thing is that because the other two types of investors are either over leveraged on the property or leveraging the property themselves on their own credit, it's a very risky proposition. Now you could take the same property, the same amount of repair costs, the same contractor, the same materials, same amount of potential profit, and by simply structuring the money differently, you mitigate most of the risk. Now let's say that our property costs $250,000 to purchase, and we're going to put $50,000 in repair costs into it. So we're $300,000 into this property. Well, if we're the second type of investor and we're planning on selling the property for $375,000, now after agent fees and holding costs and different things that you may factor in, let's say that our profit's going to be $40,000. Now, if we're the second type of investor and the economy turns and the property takes a $100,000 haircut, well, then your property's only worth $270,000. Well, you've already put $300,000 into it, and that's not including holding costs. So you're upside down. Now, I don't know of any bank that would let you refinance out $300,000 worth of short-term debt for collateral that's only worth $270,000 in a down market. So the way we structure it as educated investors is we use something called a blended structure. Now, a blended structure is a blend of debt and equity partners. So we may go get a hard money loan on that same property for $200,000, and then we'll raise in private money the other $100,000 that's needed to complete the project. Now we structure that money in a partnership. So that means that our private money partners are just that. They're partners. That means they get voting rights. But it also means that if the economy turns while we're holding the property, well, they're in it with us. And they understand that going into it. Now, because they're partners, they're going to get a share of the profit rather than a percentage rate. So their potential upside is a lot better. The potential downside is, well, they'll hang on to the property with you. And one of the exit strategies is that if you do go upside down on it, well, you just rent it out. Now, if all you have is $200,000 in debt on a property, and the same scenario happens that we talked about before, now it drops from having an after repair value of $370,000 down to an after repair value of $270,000. Well, we only have $200,000 in debt. So even in a down economy, we're in an equity position. We could take that collateral to a bank and get a mortgage for $200,000. Now, the other $100,000 that we spent is structured in a partnership. So our money partner is now a partner in a rental rather than a fix and flip, which means that he gets to share in the rents for as long as it takes for the economy to turn back around and for us to get the original value out of the property that we were planning on. So now, worst case scenario, our money partner makes more money. Yes, he has to wait a little bit longer, but you didn't lose any money for him in that scenario. You satisfied the debt with your short-term debt lenders for your fix and flip, and most importantly, you had multiple exit strategies rather than just one. Now, what do I mean by multiple exit strategies? Well, the third type of investor that we just talked about in that scenario could, in the case of not being able to sell it as a flip, rent it out, lease option it, seller finance it, and many other things. So by simply being educated and having the knowledge on how to structure the money, we've mitigated most of the risk of real estate investing. On one hand, I can understand why an employee mindset person would say that real estate investing is a risky venture. But on the other hand, if you approach it from the wealthy mindset, from a space of being educated and having knowledge of how to do it, you've mitigated almost all of the risk.